This is Talking Legal with Templars. Welcome back. My name is Dayo, Okusami. I'm a partner at Templars. With me today we have Chidubem Okoye, who's a senior associate in our finance department. Today we're talking investment and financing in the tech ecosystem. Why don't you start us off with giving us an overview of what's going on in the tech ecosystem from a financing and investment point of view?
So at present, we are currently experiencing a market correction, and we've seen a situation where venture capital, institutional funds, and general investors have pulled back on investments due to the slow post-pandemic recovery, the poor performance of the public markets, and also the doubts around if we're kind of slipping into a global recession, right? And so all that has contributed to kind of slow down investment into the tech space.
Yes.
We also see with that reduction in valuations
Yes.
for tech companies.
Mm-hmm.
And so we are sort of in a situation where one could call a market correcting itself from a financing perspective.
Okay.
And so there's a bit of slowdown at the moment.
Okay, so that's interesting. You're talking about a slowdown valuation, and I want to drill into that because my understanding of things was there was a bit of a surge in investments, not only in Nigeria, but worldwide, but certainly in Africa.
Correct.
There was quite a buzz over the last 2 years. Some would say there was a bit amount of FOMO, fear of missing out on that. Now there is, and you've talked an important point on valuation. So we're seeing a market correction in the valuation being given to tech companies, but also the money coming in.
Correct.
Now let's try and dig into that a little bit more. Historically, what have we seen and what are we seeing going forward now in your practice? Because you advise a number of companies in this space.
Correct. So historically, what we've seen is that because of the unique risk profile of tech companies, we've seen mostly equity investments come into the tech space as opposed to debt.
Correct.
And even within the universe of equity investors, you then see different buckets of equity investors depending on their risk appetite and their the size of amounts or investment they like to put into companies at different risk stages, right? And typically you'd have angel investors, for instance, invest in more pre-seed and seed rounds.
Yes.
And then you see institutional capital come into your Series A, your Series B, and Series C after startups have sort of found product market fit. Okay. Right? But what we then saw, we saw a major shift from that position. Okay. And because of the significant upside, the successful exits of a number of investments,
yes,
what we then saw was that your institutional capital then started to move towards your pre-seed and your seed rounds aggressively.
Yeah.
And so that was what then caused the huge investments that came into the market.
Almost a hyper-aggressive inflation,
exactly,
so to speak,
exactly,
on these evaluations.
Exactly. Yep. And so when you see significant institutional capital moving from Series A down to pre-seed and seed rounds,
you
then see why there was that inflation.
Yeah.
Inflation, because there were huge amounts coming to the seed and the seed round, and then has to then ratchet up to the Series A and Series B. Correct. Ultimately, right, and so of course tech companies were enjoying this huge significant money coming in.
Yes, the lawyers were enjoying the deal flow of the work coming in as well. You were busy over this period. Yeah,
exactly, and so historically, so there's been a core historical moment where VC stayed true to their roots, invested only in the Series A post-product market fit phase.
Yes.
Angel investors did the pre-seed and seed.
Yeah.
We saw the hyper-aggression. VCs came down to the pre-seed and seed.
Yeah.
And now we're now experiencing the market correction, which is VCs going back to their roots, pulling back on capital, and saying, you know what, the market isn't looking good in the short to near term, mid-term.
Yeah.
And so we want to pull back, observe things, and still invest, but more cautiously this time.
Yeah, cautiously let the tech companies prove themselves, so to speak.
Basically.
Because one important thing as well is that when institutional capital came in, it kind of pushed out the angel investors. The angels, who everyone wanted at the pre-seed stage, but brought in smaller amounts of money, were suddenly not so attractive anymore. Okay, thank you for that. Now let's move forward and let's talk to your experience also from what we've been seeing here at Templars in advising a number of tech companies in this space, right? On a going forward basis, there is market correction, but we're now speaking to tech founders and investors. They may have gotten into the market with an expectation that is no longer the case now due to this market correction. What kind of advice do you have for them, both in, first of all, understanding how and where they should be targeting their efforts towards seeking financing and investment, and then on a going forward basis, are there any touch points that they should be aware of to help them as they seek to scale up their company and operations?
I would say one word that comes to mind would be improved efficiency. And so founders need to be more efficient in seeking our capital, right? And when I mean efficiency, I would there's something I call KYI, which is know your investor. I mean, coins from KYC. Yeah, exactly. Play on KYC, exactly.
Okay. Yeah, KYI.
So I always tell my founder friends and founder clients to know your investor.
Yes.
Know the risk appetite of the investors you want to speak to. Understand your stage, your growth phase. Are you at the pre-seed round? Are you at the seed round?
Yes.
Have you found product market fit? Are you looking to do your Series A?
Yeah.
And what size are you looking for? What valuation are you looking for?
Yes, because sometimes you see a founder at pre-seed stage, they haven't even gotten it quite close to market yet.
Exactly.
And because they've read something somewhere, they have valuation. Now, also, I mean, you could say, and I'd like you to keep to the point you were making. That institutional money kind of pushed up the expectation, didn't it?
Correct.
So, going now kind of into some of the KYI that you mentioned, know your investor. What are some of the legal issues and or requirements? Because we advise a number of investors that are coming into these companies. What are they looking out for so that the tech founders are aware that these are the things that they should kind of be preparing for if they want to attract the kind of money they would like to see?
One key issue that would come to mind would be regulatory issues. And so, for instance, at your pre-seed stage, when you're still trying to put the product together, you're not very concerned about ticking the boxes from a regulatory perspective.
Yes.
And then the investors that take on that kind of risk understand that.
Yeah.
But when you start to look to institutional funds, those institutional funds are more cautious when it comes to taking on regulatory risk, for instance.
Okay.
And so you want to ensure that you have your ducks in a row and your books are all checked out from a regulatory perspective. Another point that comes to mind will be dilution. And I expect that in the current climate, dilution will be front and center of most of the deals that will happen in the market.
So we're talking about share dilution and equity dilution.
Correct.
Because clearly, if you're having more investors in the company, then existing investors will have to dilute their shareholding. Okay,
correct.
Go on, please go on.
And what even makes it worse is that new money is going to be coming in at reduced valuation.
Right.
So you're looking at more dilution than parties anticipated, say, last year before the turn of the year. And then we had all the market correction issues pop up this year. And so with dilution, what we would expect to see will be tech companies increasingly creating a new class of shares with special rights for founders and certain investment blocks to deal with the dilution that would happen on the share quantum side.
Right.
And sort of mitigate that by having those class of shares having special control rights. Right. That means that although founders and certain early investor blocks are going to be losing control from a pure share size.
Yes.
The special class or the special rights that that class of share would give them would then enable them to have control in a roundabout manner, so to speak. Yeah. And so we think dilution is going to be front and center, giving less capital coming in, more competition for capital, and that's reduced valuation. Okay. And just to make a point, you know Klarna, the buy now, pay later unicorn, right? Yes. So Klarna had a valuation of $46 billion mid last year. Yes. And they're currently in the market trying to raise at a valuation of $30 billion. And so that's a $16 billion haircut on their valuation in the space of a year. Yeah. And so you can imagine what that would do to the founders' shares, the control rights for the new money coming in. Yeah. And so we expect to see that sort of haircut on valuation
Across the board?
Exactly.
Okay.
And so startups need to think of innovative ways to manage control. And then investors also need to expect this sort of conversations to pop up and start to think of creative ways to deal with it.
Yeah, and I think also one of the an important issue is this is almost like a reality check, isn't it? It's a reality check regarding a commercial focus on valuation. It's for your growth. It's maybe better to do a lower valuation now and grow up in later rounds, as opposed to, even if you could, which would be harder in this climb now, getting a higher valuation that would, using that example you just do, see you at the next round, take a haircut.
Yeah.
Okay, now, it's not all gloom and doom. We are seeing deals happen.
Of course.
I'd say we are as busy as we were, just using the work Templars Metis practice does. You know, in our media, entertainment, technology, and IP and sports practice, we are still seeing solid deal flow, albeit market corrections. So deals are happening. It's just, like you said, there's a competition for capital.
Yeah.
Now, going forward now, what do you see the landscape looking like, and what advice do you have for tech founders and tech investors, because you have experience advising both sides?
Yeah, so what we see the landscape looking like in the short to mid-term is there's going to be more deals happening. Like you've mentioned, there's going to be significant deal flow.
Yeah.
And from my engagement with investors, what I've been told is that investors are looking to put money into companies now, particularly at the early stage, pre-seed and seed.
Yeah.
Because we are now in a depressed market, and the expectation is that by the time those companies will be going to raise their next rounds, their rounds will coincide with a rebound market, right? And so what you then see is that ultimately there's going to be significant upside if we are working in better market conditions, and so there's an increase in valuation, unlike what we have today.
Yeah.
So put some money now and take the benefits or reap the rewards down the road, right? And so therefore, significant deal flow still happening. For the startup founders, my advice to them would be, if you can conserve cash, if you can reduce your burn rate, you should.
Yeah.
If you're at your growth stage, you should probably be thinking of scaling back on expansion plans if you can.
Yeah.
And for investors, I would say there's never a better time to take risks than now.
Yeah.
Put that money in.
Yeah.
The market will always, the market's correcting itself now, but the
Yes.
markets always rebound. I mean, tech companies always push the boundaries, and we would always see tech companies win.
Yeah.
It's been happening for decades. It's continuing to happen.
Okay. Well, thank you for that. So, it's an interesting point you just made now. It reminds me of a quote by Byron Rothschild. He said, and I paraphrase, but I think it's pretty on. He said, buy when there's blood on the floor, even if the blood is your own.
Yeah.
So it goes to your point. We're in a depressed market, but these are opportunities. Conserve cash, be strategic. But also, one other point I would like to add, because I would say I'm maybe aggressive when advising clients, is apart from investors, with certain, and if it makes sense for certain tech companies, tech companies or investors, if you do have a cash pot, this might be a time to consolidate. The market is ripe and open for M&A in the tech space now.
I agree.
So if it makes sense, there could certainly be some deals that couldn't happen before just because of aggressive valuations that can happen now.
Yeah.
But you know what? You've given us a pretty good snapshot of what we're seeing now. We're well into 2022, going into 23. The market is tighter, capital is being competed for more, but we are here at Templars seeing deal flow.
Yeah.
The idea is, and I learned that today, KYI, know your investor, but there are opportunities that can be taken. So, ladies and gentlemen, thank you for joining us today with Talking Legal with Templars. We will see you next time.
Thank you.